Well, hello to you and welcome. I am super excited. Now, I'm not going to lie. I've been trying to get into Germany for the best part of 20 years. Can you believe it? 20 years. I literally went to Germany for the first time in 1999. I started trying to invest both in Shanghai and China in 2003. I invested in London in 2002. And in 2003, I also tried to get into Germany. And literally 20 years later, I'm super excited to share with you the first proper opportunity that we've had, income producing asset that we've had in Germany. So, as I say, let's invest in the powerhouse of Europe. We always talk about diversification across countries, currencies, assets, partners, and time. But ultimately, it's about the passive income. It's the globally diversified passive income that we're all looking at. And I can't believe how exciting the world has become. With Selwyn, literally a week or two ago, we were launching a Manhattan opportunity right in the heart of Manhattan, right next to the financial district. And, you know, literally with a 10% cash on cash return in US dollars in Manhattan, which is kind of unheard of. And literally that deal has already closed, which is pretty awesome. So what is it all about? You know, it's putting smart investing in everyone's pocket. And what is it about? Well, it's living a life unlimited. Today, we're not giving you any financial advice, neither ourselves nor Caleo. What we're doing is we're letting you know about a deal. We're letting you know about our opinions, our synopsis on the deal. But ultimately, the responsibility comes down to you as to whether this investment makes sense for you as an investor. However, without further ado, think of it in terms of global monopoly, global diversification. I've just shown you Manhattan, and now we literally pivot through to Germany. So what I wanted to start with is why Germany to start off with. Why did I even want to look at Germany 20 years ago? Why is Germany called the powerhouse of Europe? And if you take our GID system, again, if you do our Wealth Going Global course, you can go into the full philosophy of how to find the right partners, how to find the right assets, etc. I'm not going to go through all of that, but it always starts at a country level first and then a currency. So let's just look quickly at Germany, because I'm going to assume that everyone doesn't necessarily just know this off the bat. Germany boasts a resilient and stable economy, positioning it as the economic powerhouse of the European Union, with a robust and diversified economy, stable GDP growth, low unemployment, a well-established industrial base, and a resilient business environment. Investing in German commercial property provides a secure foundation for long-term returns. The second thing, diversification benefits. Diversifying in real estate investments across international borders can provide a hedge against market-specific risk by incorporating German properties into a portfolio, especially for those that are heavily invested in American property. It can mitigate against the risk associated with the US real estate market and capitalize on the stability of the German property market. Obviously, there are also significant benefits to investing in the euro, which is expected to appreciate against the US dollar over the next 5 years. So you've not only got the country, but you've also got the currency. You've got thriving business hubs and global connectivity. Germany is home to a thriving business hubs such as Frankfurt, Munich, and Berlin, which host multinational corporations, finance institutions, and technology firms. Investing in commercial properties in these dynamic cities, along with the industrial cities which service the industrial base, offers exposure to high demand markets and the potential for sustained rental income. Added to this, Germany's strategic location and world-class infrastructure make it a global business hub. Commercial properties, especially those in the proximity to major transport hubs, can attract international businesses looking for well-connected and accessible locations, enhancing the potential for high-quality tenants. Number 4, favorable lease terms and regulation. The German commercial real estate market benefits from stable lease structures and tenant-friendly regulations. This stability contributes to predictable income streams and reduces the risks associated with tenant turnover, making it an attractive proposition for investors seeking reliability and security. And finally, investor-friendly financing conditions. Germany's historically low interest rates and investor-friendly financing conditions presents a favorable landscape for investors looking to leverage their capital. This creates opportunities to enhance returns on investment and optimize portfolio performance. So I think you've kind of got it in terms of the major 5 whys in terms of Germany. Without further ado, though, I don't want to make this in terms of, you know, Wealth Migrate and our show, because what we are very, very excited is to have Selwyn Blyden joining us And Selwyn is one of the co-CEOs at Caleo Private Equity, who is our partner in this deal. And for me, Selwyn, firstly, thank you so much for being on, live with us. You've been one of the people that's been principally behind the due diligence. And so I'd love to, ask you, tell us just a little bit about Caleo Private Equity and, what is your role in with regards to that?
Yeah, so Caleo Private Equity is a little offbeat as a private equity house. We don't manage a fund in the way various other private equity managers do. We look for direct investments, so individual investments, and then we find investors who are right for that investment. And we have an open mandate. We look at any kind of industry in any kind of location. In principle, as it turns out, a lot of our work is in developed markets because that's where we have a lot of investor interest. And my partner in the business, Glenn Scorgie, he and I have a history in finance. We met at R&B and we ran a business in R&B that was quite property focused. So property is also one of our interests, and we have networks in the property sectors in developed markets. So we try and go to our natural homes and where we can understand things. But our key, and this is similar to you, Scott, our key is to find the right partners. There's no way we could run a deal in Germany or run a business in the United States as we have investees in the United States or in the UK or so on. So we try to partner with people who have the expertise, who have shown track records and have the correct structures in the countries in which we're investing and in the correct industries that we're investing into. So and the deal we're talking about today is a case in point.
Yeah, I just wanted to show you, just before we go there, I just wanted to show people. So this is your website here, Caleo Private Equity. You talk a lot about communities. And I think, you've just spoken about partnership and communities. And, if I've learned one thing about investing internationally, you need two things. You need the right information and you need the right partners. So how do you do that? Well, these trusted communities, talk to us a little bit, and let's use, you're about to go there, case in point, your German partners, to some extent, even your Manhattan partners, it's all come through your broader community.
Yes. So the people who are running this transaction in Germany are people that I was introduced to through a friend of mine who actually is also associated with a Manhattan project and who I've known for more than 20 years and I've invested with in my personal capacity. And so we've been monitoring the managers of this opportunity for several years. We've seen them source, manage, exit. With Caleo, this will be our third deal with them. So there's a kind of established relationship, and there's several ways in which we can monitor the behavior. So it's a bit more than a network. It's I like that word, community. It's a word that we use often in our business. So it's somebody who knows somebody through multiple ways, and I think that's important. So in this instance, this is not our first investment with this management. It's not our first investment with this investment thesis, with this kind of motivation. And a lot of our due diligence is actually just dependent on, I have to admit this, it's not original due diligence. It's relying on a team that knows how to do these things, knows what questions to ask, technical questions, taxation questions, structuring questions, legal questions in this kind of in this kind of setting. I see there's a question about the name of the German partners. The people we work with are Encore. Encore have done several transactions like this. They're a private investment house. We have an allocation from them, and we'll talk more to that later, I think, Scott.
Do me a favor, just it's quite important, I often joke with people, in the middle of COVID, your partner, Glenn, got hold of me because I've been hacking him to get into Europe, and even more so specifically Germany, and even more so income producing assets in Germany, because I've never been able to find one. I've been sold houses and lots of other stuff, but never an income producing asset. And the point being is that there was an opportunity back right in the middle as COVID was happening, middle of June, about June 2020. And I really wanted to execute. It was a small deal. It was only like $700,000. It was like euros. It was an equity release. And I tried to get in, I tried to get our investors in, and we just couldn't move fast enough. And as I understand it, you guys exited that position in under 18 months. with a 1x, 1.8 multiple on capital, which in IRR terms is 40% plus. And I think I'm just reiterating what you're talking about. This is your third deal you've done with these people. They've not only executed, but they understand how to do it, and you and your investors have done it successfully already with them.
Yes. So that particular one, I think we were, and I'll describe a little bit of the thesis. So we went into that deal. We first committed to it just before COVID, but we stuck with it. It was actually not. In retrospect, we were quite courageous to stick with it, but obviously we were justified by the outcome. The thesis for this property and for that property and for the property that we're going to talk about now is properties that are resilient to things like e-commerce and big secular changes. These are fundamental properties that are meeting very basic needs. And I spent a lot of time with the head of Encore Properties, Peter Katz. Peter has said to me he's thought about this a lot. He's monitored different sectors in the property market, and he wants to focus on properties that have always shown resilience, that showed resilience through the global financial crisis and through big secular changes. And nobody could have foreseen COVID, and that wasn't the kind of change that when he first started with this thesis that he anticipated. But those particular properties that you're talking about, that portfolio that we invested in, that was an investment into big warehouse DIY stores. And it just turned out that during COVID, those stores were allowed to stay open. Generally, one of those stores closed for a brief time during COVID, one of the 3 stores in that portfolio, but the tenant continued to pay throughout. The tenant is one of the biggest DIY traders in Germany called Obi, and the thesis completely worked. DIY stores had to stay open because people needed access to that. And there were still online sales and so on. So the tenant remained very strong throughout and wanted to maintain those locations and paid rent right through, even during times when one of its stores was closed. So, and then in the end, stabilized portfolio, lease extensions that were well negotiated by the team, it became a very attractive, high-yielding asset for an institutional buyer, somebody who's kind of just a one tier above where we are. And there was an exit much sooner than originally anticipated. And through what you would have anticipated or would have thought was one of the most difficult market conditions that you could possibly imagine. So part of it is managing the assets well, having expertise. The initial thing is selecting those assets well and understanding what it is that you have as your investment thesis. And you've mentioned Germany. Germany is the kind of market in which you can act out that thesis. You're not speculating a lot about the general economy. You're not speculating a lot about dramatic changes that are likely to occur. I mean, obviously, the world can be a very different place. We don't know how things turn out. But in general, this is, as you've said, the powerhouse of Europe. It's the world's 4th largest economy, just a little bit behind Japan. It's the world's 3rd largest exporter. And many of the industries that operate in Germany and many of the major employers in Germany have been around for ages. I mean, many of the brand names that we are familiar with. In Wuppertal, the town we're going to look at, I looked at one of the biggest industries there. It's dates back to the 19th century. Vorwerk, the manufacturer of Thermomix and so on. It's been a family-owned company since the 1800s,
sure,
and employs thousands of people there, thousands of people in the United States, and so on. So there is something about Germany and following an investment thesis like the one that our managers are following.
Last question before we pivot into the deal. I just wanted to share this again. So for me, due diligence is so key. And what a lot of investors say, no matter how sophisticated they are, it's always very hard to kind of, do stuff internationally, different markets, different countries, et cetera, et cetera. So, when you look at Glenn and Selwyn, the 2 co-CEOs of Caleo Private Equity, both of them have extensive experience, not only in the private equity space, but more specifically in the property private equity space, which I think is really, really important. So you can see both Glenn here, a CA by background, a huge amount of experience in terms of the whole property sector. Selwyn, a PhD CFA by background, and he's not allowed to say it, but I will, but a PhD in mathematics from Cambridge. So, but my point being is that the way they operate within the team is that there's a huge amount of understanding, background, and experience in terms of looking at due diligence. And as he said, you're relying very heavily on good partners, firstly and foremost anyway. But even then, you still have to analyze, as he's been talking, the thesis, the numbers, the due diligence, et cetera, et cetera. So I just wanted to, I don't know, Selwyn, if there's anything else to add, but I just wanted to show the capability and credibility. I mean, Caleo as a company and per se is a family office. The broader network, managing over $600 million. It's an extensive network of people that help high net worth investors and ultra high net worth investors invest. And Caleo Private Equity effectively is the private equity partner in that ecosystem, and obviously is doing the due diligence and putting, deploying capital arguably as safely as possible through due diligence into private equity deals. I just kind of wanted to give context for people as to how it all works,
Scott, there's nothing I can add to what you've said. Thank you.
Cool. So do you want me to share the screen, or do you want to share the screen? I'm very easy, whatever's easiest for you.
No, I'm fine for you to share the screen.
Cool.
Because I know you'll have comments. I know you well enough, Scott, to know that you'll have comments.
Cool. So let's just get this up here quickly. So it's a PDF at the moment. Firstly, a nice, attractive building in terms of the overall process. So I'll sort of hand to you. It is self-explanatory for people, and they do have access to this document in the platform. But over to you, Selwyn, in terms of understanding this.
Yes. So, the investment highlights, I think I'm going to focus on a couple of things. One is, this is a mixed-use development, so there are multiple sources of income. It's not just retail, for example. It's not residential. It is a commercial building. And the thesis behind it is that these are fundamental need tenants. And we'll talk a little bit about some of the specific tenants a little bit later on. The property itself, it doesn't say so over here, but this property is literally 5 minutes walk. If you go onto Google Maps, you'll find it's 5 minutes walk from the central station at Wuppertal. Wuppertal itself, we'll talk a bit about the town, but Wuppertal itself is in the Düsseldorf area and in North Rhine-Westphalia. A couple of key things about the property as it currently stands. It's a stabilized property. It's got in-place tenants that are very well established, and in many cases, they're actually international scale tenants. Netto Supermarkets, for example, is part of the Edeka Group, one of the top 5 food and beverage retailers in Europe. McFit Gym is one of the world's biggest gym groups, with over 6 million members. So the property is currently close to fully occupied. There is some space and there is some upside. One of the key things about so the property itself, I think, is a very attractive asset in terms of location, in terms of other elements that you'd look for in a stable income generating property, such as tenant mix, and then also the tenant deals. At the moment, the weighted average unused lease term, the WALT, is 8.5 years. So just to think about that means, on average, tenancies are expiring in more than 8 years' time. That's quite exceptional to see in any building.
Just to show you quickly. Sorry, I don't mean to butt in, but if you look here, the Netto is 2035, the McFin Gym is 2030, the Boutique Hotel is 2041. I just wanted to kind of give people perspective on what you're talking about.
Yes, so I mean that's actually quite rare to get leases of that length, and to have that kind of stabilized income. Leases are CPI linked, so this is a real asset. And then the deal itself, it's very good entry point, estimated 15% below market. So that's something just worth keeping in mind, that you've got quite a lot of upside there already. And again, there's not a aggressive thesis here about repositioning the asset or re-tenanting and so on. It's about managing the existing tenants, filling the existing space, enhancing value through, for example, solar, and through improving the current parking, the parking garage portion and so on. So it's relatively simple. And for managers that have done more complicated work, on other assets, I think this is completely within their capabilities and within their range. So that's it. Another important thing about the deal is it's being acquired with its existing debt. The existing debt is at a fixed interest rate of 2.3, so that's well below current market, and there's still close to 3 years to run on that. So for the next while, there isn't really a lot of fear, at least for this asset, about interest rates going up, and the income to equity holders is relatively stable, or should be expected to be quite stable over the coming years.
Talk to us a little bit about this, the significant capital growth potential given the purchase price discount to current market and the sale during a superior market condition.
Yes, so we're coming in that 15% number is taken from Encore itself, from the managers. I actually think it might be higher than 15%, because the incoming asset level yield is 6%, which is very high in a market of this sort. So I think this is an asset which is in a kind of small institutional size. So it's quite an attractive asset for investors like ourselves to buy. We're not competing with major asset managers and pension funds and insurers and so on. But it looks like the entry price is quite substantially below what you'd expect in market. So this is, as I understand it, it's actually a semi-distressed, not entirely distressed, but an eager seller.
They always say rule number one in property is buy from a motivated seller. So
yes,
that's exactly what
I think. Yes, so I think this is a motivated seller, and I think this is also well timed in the market at the moment. I think to be able to get 15%. I think other people who have big portfolios, for example, are worrying about interest rates and managing their cash flows and so on. So as incoming buyers, I think we're being presented with quite a good opportunity here.
I think just before we move off there, I know there's a lot of information on here, but in simple terms, another thing that's important is the current market rents are below market average. That's always a good sign. The other thing that's great is that you have spoken quite a bit about this in terms of the thesis already, but it's got daily needs, both food and non-food, which makes it very secure and stable, and also defensive against online retail threats and economic downturns. So it's that typical, if you look here, between banks, offices, food, non-food, hotels, fitness, parking. It's the biggest parking garage in Wuppertal, etc. So it's just giving people an idea of all the different things. And then the only other thing that I just wanted to show people, which I thought was relevant, was it's got this. I think you mentioned already. We'll actually go to the hotel operator. So let's talk about that. You spoke a bit about Wuppertal. I'm sure, like many other people, I had to go Google it in terms of the size. But yeah, I mean, here's the sort of the numbers around it. I don't know if there's anything else that's relevant here, but I'll over to you first.
Yeah. So Scott, one of the interesting things that people should know about Germany is, you mentioned when you were talking about Germany, I think you mentioned Frankfurt, Berlin, and Munich. I think those were the towns that you mentioned. Those are the cities that you mentioned. But Germany has a massive industrial base that's spread out across the country. And there are many towns that you and I are unlikely to visit and may not even have heard of, that are headquarters of major industries, or are industrial towns that are very substantial in their own right. So, for example, Volkswagen's based in Wolfsburg. Audi's based in also some small town, I can't remember what it is. BASF is in Ludwigshafen. So there are towns in Germany that have very strong economies of their own, but are not towns that you would have heard of. Wuppertal, I think, is one such town. It has good industries, manufacturing, chemical, automotive supply businesses that have been there for ages. The one business I mentioned, Vorwerk, as I said, has been there for multiple generations, since the 1800s. It produces Thermomix. It produces its own brand of vacuum cleaner and so on. It's got a strong established infrastructure. There are companies like Coroplast, which is a major automotive material supplier, for example. So it's got this big industrial base of its own. And then it is very close to Düsseldorf, which is a business hub in its own right. It's a telecom.
Sorry, I'm going to bounce a little bit, but I know you got a map here, so this is great. So there's Düsseldorf there, and there's Wuppertal, and you kind of there's Berlin and Munich, just to give people a sort of an idea.
Yeah, so there you get so Düsseldorf and Wuppertal, they're really on the far west of Germany, and Düsseldorf, for example, is the headquarters of Trivago and the headquarters of Vodafone Germany, and Wuppertal itself. I always hesitate to kind of say this kind of thing, but the same way kind of Stellenbosch is to Cape Town, or Germiston is to Joburg. It's really right there next to the major city of Düsseldorf. It's roughly 45 minutes drive from Wuppertal, central Wuppertal, to the center of Düsseldorf. By train, it's 21 minutes. Staying in the hotel that's part of this property, it's 5 minutes walk from the Post Boutique Hotel to the station, and 21 minutes from there to the central station at Düsseldorf. So within half an hour, you could be in Düsseldorf if you were staying here in Wuppertal. But obviously, as I said, Wuppertal has its own business activity, it has its own industrial base. It's quite remarkable from that point of view. It's also a university town with 23,000 students at the university there. So the opportunities in Germany are a little bit different from what you might see in other places. It's I've met, for example, investors who look at the UK and don't want to be outside London. They're even scared of Manchester or Birmingham, for example. That shouldn't really be the case in Germany, where you have a very diversified and widespread business base, and where you have strong support for property fundamentals in towns like Wuppertal. Other towns that we've invested in are Schwerin, for example, Solingen, those kinds of towns. Those are not big towns in their own right, or not huge towns in their own right, but they have very strong fundamentals. And by choosing the right kinds of properties, you can get good yields, good support, and have relatively stable cash flows and good exits as well. Institutions do look at these towns. German institutions and institutional grade buyers do look at these towns to accumulate assets.
That's excellent. You did talk a little bit already to the key tenants, all three of them actually. I don't know if there's anything else relevant. Obviously, everyone has access to this information.
Yes.
But I think the only thing that I wanted to point out is, if you look at all of them, firstly, again, to remind you of the leases, really long-term leases, but also look at the size of the companies. This is not a little mom and pop store on the sideline that's got a 10-year lease. These are all major institutional players that have, these long leases. So it really, back to your whole idea of an exit to an institution one day, the caliber of the tenants has a massive impact on whether they are or aren't interested in an asset.
Well, so there's one other tenant we don't mention because we don't have space for it, but that's Postbank, also quite a big tenant. Their lease is until 2028, and Postbank is the retail banking part of Deutsche Bank, just so that people are aware. So just generally, this asset is an institutional asset. It is that central asset in a town the size of Wuppertal where you would find these kinds of tenants. The hotel is interesting because hotels generally are not, for traditional property investors, hotels are a little bit different. This is a leased hotel. It has a long history in the town. It has a strong manager. It's family-run business, and it's got very strong security in terms of its lease. So that is something which is a little bit different from our normal property investment. But given the weight in the total leasing mix, and given the strength of the other tenants, and given the specific structure of this hotel lease, it's something that we felt quite comfortable with when we looked at. I did interrogate it a little bit. I think it's quite interesting how they've structured that.
So let's get into the meat, in terms of the investment terms. And I think, if I said to you, so okay, cool, I'm interested. I like the fact it's in Germany. I like the fact it's in a euro. The fundamentals of the city make sense. The sector seems to make sense. The partner makes sense. What am I investing in, and how does it work?
Yes. So what's going to be established, or in the course of being established, is an investment entity, and that's where we will buy our interest. So obviously things will be structured through your platform, Scott, for your investors. But from our perspective, we're investing directly into an investment entity that, for tax efficiency, will be located in either Luxembourg or Cyprus. So that'll be finalized in the coming days, exactly how that works. In terms of the economics, just things that your investors should be aware of. Think of the investment term as a 5-year term. The investment that you mentioned, we went into thinking it was a 5-year term. It turned out to be less than 2. But the underwriting and the business planning is based on a 5-year horizon. So that's just something to be aware of. Initially, the yields are going to be, this is before fees and other structuring things on your side, but from our side, should be a little bit above 5, going up into the 7s over the life of the investment, with semi-annual distributions.
Yeah, I think that's quite important. I just wanted to point that out for people, because we tend to, traditionally, we've sort of had quarterly. So I just want to make sure people are aware that biannual means twice a year in simple terms.
Yes.
Okay, so just make sure we're clear on that. And as you know, the expected range, as he's saying here, is sort of 5.2 to 7.5. Obviously, it's changing over the life,
Yes.
in terms of that time.
Yeah, so that's expected to go up kind of 0.5% a year, roughly speaking, as the leases adjust with CPI, and we're able to achieve some of the other growth elements that are built into the business planning. The total IRR, the total return, is expected to be above 15, and that's based partly on the good entry price and benefiting from that over the life of the investment, and then obviously taking into account the yield as well. There is also a sense that the current entry price would have to be a little bit of yield compression. I don't think it's been aggressively modeled, but there is a belief that we should be able to get a better exit yield than we are getting as an entry yield. Or even so that's really where the 50% plus internal rate of return comes from. So that's a very strong internal rate of return for a euro asset.
Yeah, I mean, I have to say, I haven't, and again, I've been trying to get into Europe for a long time, like I said, and 15% IRR in Europe, specifically in Germany, is unheard of often, in terms of that process, particularly for a stabilized asset as well, Selwyn, which I think is important to recognize. Yes. We haven't said that. You mentioned it to us before we got, before we went live, and you're dealing with a very stabilized asset here. And I'd love you maybe just to talk a little bit about that, because I think it's important for people to understand the stability of the asset, the stability of the rental income streams, etc. And therefore, the IRR is interesting based on that, stability.
Yeah, and I think that is actually a little bit surprising that you can get such an IRR. And I think I'll talk a little bit to the business plan first, just to address your stability of income. That really is a function of the tenants that we've seen and the other and just the track record of this property. So this is a central property. This is a landmark property in the town, and there is very strong occupancy, as we said, 98% current occupancy. It just is an established income producing asset. There isn't aggressive lending against it, for example, or borrowing from the property owner. We're coming in at 53% loan to value. So there is a sense in which we aren't really taking a lot of financial structuring risk either in terms of the stability. But yes, as looking at both the property level and the financing structure level, I think this is actually very stable and very well structured. It's the 15+% is based on, if I were to break it down, if I look at and just scrutinizing the model, as things I've already said, the entry price, where you're coming in at a discount to market, there's an expectation that we could get a little bit more income out of the property because we're underlet, that 5% below market. So we could do that on some of the space that's available for us as we renew leases or renegotiate existing leases. And then there's CPI, which will lead to growth in the income yield. And then there is market movement, an assumption that even though we've come in at this kind of level, there will be a little bit of yield compression over time. And that's not aggressively modeled, but the combination of all those factors gives you a very strong internal rate of return. And then obviously, because it's cash generative from day one, or that's the expectation, it's modeled as cash generative from day one. Yes, it's not as if we're waiting for big capital appreciation or for some hallelujah refinance or whatever else, as you might see in various other property deals. This is not an aggressive business plan, but it has an astonishingly high IRR.
One last thing that I just want to point out before we go to the next slide is that this 1.8 to 2 times 1 multiple. And in simple terms, what that means for people is if you put in $100,000, over the time period, the expectation is you get back, let's just call it, if it's two times, you're going to get back $200,000. So it's just, you're going to get, if you put in $100,000, you're going to get somewhere between $180,000 and $210,000. And it's just a simple metric that people like to use as well in terms of, overall return. So I just wanted to kind of point that out as well, on top of the numbers. Okay, are you happy for me to bounce here, Selwyn?
Yes, I am.
Okay. So what I want to do quickly
you wanted to talk about risk at some stage?
Yeah, we're going to go. Yeah, that's where we're going to go now. So what I wanted to do quickly was we've been through the investment opportunity. We've been through the location in terms of where it is. I just wanted to share with people quickly how they would invest. We're going to come to finalize with what the risks are and how they've been managed and what the opportunity is. But if an investor wanted to invest, they've got their investor wallet. They effectively go on the platform, the Wealth Migrate platform. They've got the investment opportunity. We effectively aggregate it through a tax-efficient structure. We got the deal ownership. When the dividends and the equity capital growth are paid back, it goes back in the deal wallet and it goes directly back to the investor. To show you that in real life, because this is where I get super excited, is that if I literally log in here and I go back to Wealth Migrate, you can go in, you can see the deal is here. It's still under review, so we're just waiting for a couple of things to get it to go live. We still got to update a couple of the numbers, etc. So for now, this still is being finalized. But what I love about it, you got access to all the information, you got the risks. If you want to go in and you want to figure out, okay, if I'm going to put in $10,000, what does it mean? And in terms of fees, etc., it's all here. You can go read all about it. Everything's here. So you basically got it. Oh, and the other thing I want to show you, which is cool, there's a video here, which is a very short video that Selwyn's partner Glenn did with me. We'll now put up the webinar here, but you've also just got the pictures, in terms of, the different stuff, all the different pictures. And then what's also important is that you can go and download the brochures here. The very brochure that Selwyn's been referring to is here. You can literally click on it and it'll download over here. So you've got access to everything. I want to show one last thing quickly, Selwyn, before we go to the opportunity. And I did this specifically tonight just to show people how easy this was. So the German deal is not live yet, but let's assume that I want to invest in the Manhattan deal. And I literally go in, I want to put $1,000 in, I go continue. I basically acknowledge the agreements, the digital agreements. I can go and, download the digitally signed agreements. I'd recommend you download and read them. I literally go confirm my investment, make my investment. And I always laugh at this point, but can you literally believe you've just watched me invest in America in under 30 seconds? If I go view my portfolio, I can literally go in, I can see my investment here. And the moment I see, oh, wow, I've done it twice. Okay, I made a mistake. I can cancel my investment and remove it. And the moment Germany goes live, I can do exactly the same thing. So I just wanted to kind of give people a feel for how easy it is. And then once I've actually got the investment, I can go in, I can see my whole portfolio, all my different fund investments. I've got my wallet, I've got all my different returns, all in one place. I can manage absolutely everything. Our digital wallets are with Lemonway, the biggest digital wallet provider in Europe. I can have a profile in my own name. I can have a profile in an offshore company or trust. So anyway, I'm not here to sell Wealth Migrate. I'm here to show you how easy it is to be able to participate in a deal like this. So let's just go back to the presentation here. And where the hell is it gone now? Oh, there it is. And what I wanted to share with you was just, we were talking a little bit about the risks. So can we talk just to the four different risks that we looked at, or five actually. So the first one is the tenant lease termination. Your thoughts around this?
Yeah, I don't, you have to put this down as a risk in any property transaction where there's an existing tenant base. But if you look at the tenant profile that we spelled out, we don't feel that there's a lot of risk here. That we think it's relatively well mitigated given the strength of the tenants, them being part of these giant groups and the long leases that are currently in place. But yes, it is something that you would have to put in if there were to be, for example, a tenant failure that would be significant for the property. The benefit of having a mixed-use property where you have tenants that are really independent of each other is that obviously you'd still have the income strength, and you'd still have, you don't have a single tenant risk, for example. You actually have a diversified risk underlying your income as a result of it.
I was actually going to back you up with that, because, you know, in 2008, when Lehman Brothers went bankrupt, they owned the entire Canary, well, not owned, they rented the entire Canary Wharf Tower. And so they had no diversification, whereas here you diversified across tenants, but also across sectors, which I think is really important. Financing risk. So the interest rate is fixed for 3 years. You know, obviously there's possible refinancing, etc. Talk to us a little bit about this.
Yeah, so obviously once the current debt package comes up for refinancing, and I assume the managers are going to start discussing this a year and a half or 2 years from now, well ahead of the current package coming up for expiry. I think there will be quite a lot of interest. Firstly, Germany is a fantastic financing market, property financing market. It's got these Landesbanker, it's got a big institutional financing base. So there would be a lot of interest, I think, in financing this. I'm not concerned about there not being a takeout lender or new lender. But obviously there is a little bit of uncertainty because this is a couple of years away. And currently the interest rate is fixed. We don't know where interest rates will go in Europe. The assumptions seem to be, just based on my own reading, but none of us is an expert, none of us has a crystal ball, but it does seem as if interest rates are pretty much as high as they're going to be, or close to that, and we would probably get a better interest rate environment in the years to come. The one thing that investors should be aware of for this particular property, in a positive sense, is that currently the interest rate cover is 5 times, which is very strong. In other words, the current income of the property services debt very easily as things currently stand.
By the way, again, that's phenomenal. In America, if you're 2 times, you're
yes.
The bank's generally looking for 1.5 to 2 times.
1.5 times.
It's actually unheard of, you know.
Yes. So 1.5 times is the normal debt service coverage ratio. Interest coverage ratios, certainly when I was a banker lending money, 2 times was our kind of metric. So for this kind of property, currently where it is today, it meets its covenants, or meets traditional covenants very, very easily. And so I would expect it to refinance very easily in 2 or 3 years' time. And then it does depend on the market dynamics and how well we do there. But that is potentially a positive risk as well, because you could get a big capital release, or you could get some kind of value uptick as a result of a good debt deal being done.
The market risk?
Yes, so the general market risk.
About the cities already, but yes.
Yes, I think we talked about this, but obviously there are market risks as under any conditions. You know, Germany has a very strong economy, but yeah, there could be broad-ranging global risks and so on that could affect the market. Specifically in the EU, I suppose one of the things that friends of mine in Germany have said to me is fear of Russia, for example. There are those kinds of concerns. The EU itself, Germany is pretty much the kind of strong center of the EU, being such a big country and being such a strong economic power and diplomatic power as well. But yes, there's the possibility of economic risk. We wouldn't expect those risks to affect the specific property. I mean, we think this is the kind of property that is resilient to those kinds of risks. But I think it's correct that we list that risk.
Yeah. And then the final one is just we were talking about was the business
Yes.
plan risk with the exit assumptions.
Yes. So yeah, you and I just were discussing this earlier. This property has a relatively simple business plan. It's taking an existing stabilized property, buying it at a discount, managing it reasonably well, improving one or two elements to the property that would enhance value, enforcing CPI-linked lease escalations, for example, and then positioning it for exit through good refinancing and so on. But the underwriting, that 15% IRR, for example, that is based on an idea that there will be exit options in 4 to 5 years' time that are at the kinds of levels that we're used to under normal economic conditions, with less interest rate volatility, less fear, less global uncertainties in the region of Germany. So there we're assuming an exit yield of about 4.6, for example, which is reasonable, very reasonable given the history of German properties at this level. But there is a risk associated with that in terms of the exit assumptions.
Yep.
And then the other elements of exit, for example, existing leases and so on, I think we've dealt with in the previous risks.
Yep.
But
I just want to run through. I don't think we need to take as much time, but I just want to highlight what I took out as the important from the opportunity. So firstly, the strong fundamentals for Germany, especially the industrial towns. You're buying the property at a 15% below market value. You got significant capital growth potential given the purchase price discount to current market and the sale during superior market conditions. You got attractive interest rates, 2.3% fixed for 3 years. You got a stabilized asset. You got 98% occupied with long leases in place. Actually, 8.5. I can actually put that in, but anyway, I haven't. You got mixed use property without any single reliance. You've got daily needs for retail, so both food and non-food, and that basically leads to the secure, stable income. You've got income producing asset, in the region of, well, as we said, 5 to 7.5% in terms of cash on cash. You've got an established partner with a very long track record. They also, this is one I didn't ask you, Selwyn, but are they, how do the partners work? Do they put their own money? I know between us, our investors, we all put our money into it, but how do the partners work in Germany?
Yes, they put their own money in as well.
Yeah.
So that they're alongside us in the equity.
Yeah,
and I actually don't know the exact amount, but it is they're similar to us in the sense, and when I say us, it's kind of Caleo, where they're a small team built around the track records of just a couple of individuals. So yeah, the amounts of money they put into individual deals, that they also have shareholders in their business who will put money directly in. So I know one of their principals is putting 1 million euros into this transaction.
Yeah, and I think this is just important. I always say when looking for a partner, there's 3 things you want. Firstly, they've got a track record of at least 10 years plus. We can tick that box easily. Secondly, they're single focused, which they are. And thirdly, are they putting their own money into the deal? So, we're ticking all 3. And then basically number 12 is I think we've probably been through it enough tonight, but it's the extensive experience of Caleo's network, Caleo private equities, team, Selwyn and Glenn and their team. So, you're not just dealing with partners on the German, front, but you've also got partners at the Caleo infrastructure. So for me, that in a nutshell is actually the entire opportunity. It is an exciting opportunity. I know that Alex wanted me just to mention in terms of, the numbers. So if I go back to this here quickly, in terms of this. So this is some of the overall numbers. We are putting the modeling together in terms of the exact numbers because we always like to, often it might be gross returns. We always want people to make sure that they know what the net returns are. So we'll do the cash flows. The models will be there. That's why the deal's not live yet. It's under review. We're literally getting all that between Selwyn and our team. We're crossing the T's, dotting the I's. The moment that's done, it'll be on the platform. Just always be aware of net because I'm a big believer in net and what you actually get in your pocket. And then just in conclusion, I just want to let you know, because I'm super excited that, and I'm not going to talk to it now, but another deal that will be coming down the pipeline in the near future. So we've gone from Manhattan to Germany and all the way back to Austin, but this is a private equity deal that is coming up in, either later this year or early next year. You're generally looking at about a 9% cash on cash. It's a 3-year investment. And so it just gives you a different essence to it. And I know, Selwyn, we've already got a recording of you talking about this. In fact, I've already, put it, I've got it ready for when we put it up, and we'll do a separate launch around this. But I just wanted to give people the essence of what I believe truly in terms of diversification, because, between, Manhattan and Germany and now back into private equity in Austin, you've really got access to some, amazing opportunities. My final question to you, Selwyn, before we close out, there's a bunch of people that will be sitting here going, it's the 30th of November, it's been a tough year. I tell you what, I'll look at this in January. And my question to you would be, how often do you get good deals in Germany that come along? And should people be paying attention this side of Christmas? Was this something that will be around in January, February, March next year?
Scott, we didn't rehearse this question, but yeah, this is I think people do need to make up their minds in really in the next couple of weeks. I think we need to close this out. So the intention is for this deal to be closed contractually before the end of the year. So certainly from your investors' point of view, they should be making up their minds pretty much now in the next, as I said, in the next couple of weeks. To just put it in perspective.
Just quickly there before you go. We've actually put the closing date for the 14th of December. So
okay,
and Camilla said, yeah, if you've got dollars in your wallet, don't worry, because we do the investment, that's fine. So you'll be able to participate with your dollars in the wallet. There's no issue. It gets transferred into euros, so don't worry about that. But 14th of December is our closing date on this.
But to your point, Scott, as well, this is, I mean, you said it yourself earlier. Since the start of 2020, from this sponsor, we've seen 3 deals. This is the 3rd. That gives you some sense that, a deal comes along on average once a year. They're very careful in their deal selection. They've gone through long periods where they aren't doing deals. We aren't so keen to work with other partners. We'd have to vet those other partners that have to fit into our network. It may be a long time before you see another deal that meets these kinds of that has these kinds of features, and certainly one in Germany, and certainly one from the sponsor or from us. So yes, I'm very eager in terms of the Caleo clients, for example. I'm very eager that people take the opportunity now, and then. Yes, maybe next year there'll be another deal, but I can't guarantee. The other thing is that this deal itself was first flighted to me and shown to me several months ago. So it takes a while for a deal to reach this stage of maturity and be ready to be investable, just given the negotiation, structuring, and due diligence cycle that we have. So that's another thing. So if there isn't a deal that's currently reaching that stage, then you know that there's going to be a long wait before that deal comes on. I do not know of another deal that is kind of, in the pipeline right now.
So my suggestion is I've got a poll up. You should be able to see the poll up. I'm just going to talk a little bit while that poll is up. So I think Selwyn's been slightly polite as well. From a Wealth Migrate perspective, and I want to use the word never. I want it to be bolded. I want it to have underlined. We've never had a German deal, and we've never had an income-producing German deal. I'll go further to say that we have had other European deals, but they've all been growth products, so new developments from John Raby, etc. We've never had an income-producing deal in Europe. So if you're interested in Euro and getting access to diversification in Euro and income-producing assets, this has never happened before. I've been screaming and shouting and begging and pleading and on my hands and knees with the Caleo team to get involved in their deals. And as I told you, the one that we were given the opportunity 3 years ago, we had to move within 10 days, and we couldn't act quick enough. So please, investors, do not take this lightly if you're wanting. I certainly won't be in terms of being able to get access to Europe. Yes, in America, there seem to be sort of more deals that come up, just it's a bigger place but good quality partners in Germany. And I'm not sure, Selwyn, if you've got the same problem I've also got, which is where in England, America, Australia, I could often go and find partners myself. And I kind of understood the market because they speak English and the law system is quite similar to what I'm used to and whatever. One of the reasons I struggled so much with Europe is I don't speak German, I don't speak Italian, I don't speak Spanish. et cetera, et cetera, et cetera. And they've all got different legal systems. And, so you've really got to have partners on the ground that know what they're talking about.
Yeah.
And, and I just wanted to reiterate that. It's another reason why Europe's been this market that has been so difficult for me to get into. And I'm sure Alex would back me up here, but I've always said all along, there's no ways I'm getting on an airplane to fly to Europe to try to find partners. I'm only going to go through the likes of a Caleo network because they've already got established partners on the ground.
Yeah, Scott, I think also it's quite important to note that I think every single investor that I've ever spoken to has wanted exposure to Europe. And I remember having conversations with investors about 3 years ago about the investment that was mentioned by Selwyn earlier, and we tried moving money, we tried getting everything done, we tried getting the KYC sorted, and, they were very unhappy with me when I told them that we missed out. So I've already sent the message to all of them saying, hey, is this our second opportunity now? So I would urge, or literally, you can't tell me I didn't tell you so. So yeah, this is our second opportunity. And yeah, let's get moving and let's get into the deal, because again, everyone wants diversification, and that's at the core of our investment thesis of what we offer. So yeah, Selwyn, thank you very much. It's been a lot of fun watching you talk about this deal, and now it's just about getting it live.
So just to finish off, 56% of you have filled in the poll. If you fill in the poll, imagine like I'm a golden genie and I can help you get into the deal, because I think this is going to go pretty quickly in terms of that process. So fill in the poll so that we've got just some insight into what people want. I just want to finish off with 2 closing comments. Again, you can try and do it all on your own. If you really believe you can fly to Europe and do all the investment yourself, find the partners, do the due diligence, invest in a deal that's worth tens of millions of euros, then my strong suggestion is try go and do it yourself. But I can tell you a far simpler and safer way is to do it through partnerships, to live by the laws of nature. A bird can go 70% further on its, in a group than it can on its own. So that's my strong recommendation. And I always finish with, money won't create success, the freedom to make it will. And what I'm super honored and grateful to you, Selwyn, is firstly, and I actually forgot to mention this up front, is that you actually had your year-end function today and very kindly came to join us. So deeply grateful for you coming and sharing with our community, not only tonight, but also this opportunity. So yeah, sincere thanks to you, to your Caleo team, and to everyone who's live tonight. It's always wonderful. If you've got any questions, we've got 3 minutes left. I promised Selwyn it wouldn't be more than an hour. If you've got any questions, put them in there. I don't see there's any coming in, but yeah, I'll hang around just in case there's a couple coming in. But yeah, I honestly believe that in summation, Selwyn, you've done a great job in terms of sharing everything with us tonight. Your brochure is lovely and simple. Sometimes I hate brochures that are 500 pages long and you don't know what the risks are and you don't know what the opportunities are, etc. So I think you've done a great job tonight in emulating for people what's involved in this deal, and also to the level of depth you go. So, I've read all the brochures and whatever, but it was the little things you said, like it's 5 minutes from the station, and you dropped in little things all the way through that I can tell, having done this for 28 years myself, how much due diligence and understanding you have in this project, which is much deeper than a 7-page brochure that people are looking at. So thank you.
I appreciate that. Thanks, Scott. Thank you. And yeah, thanks to everyone who turned up tonight.
Awesome. Thanks, everyone. Have a good one. And I look forward to you all being investors in Europe. Cheers.